increasing lack of focus on case counts, and I'm wondering whether that's the correct assessment. I would have thought that the larger the number of case counts, the more chances are we get more variants. Am I looking at this the right way?
Yeah, I mean, there is that worry out there, right? I mean, we've seen in the U.S., in the U.K., and Israel, we've seen huge numbers of people get vaccinated thus far, but there are, pockets of the population in all these countries that have, raised the head in their vaccination. There are still, people who are unprotected, and there's, lingering reluctance to get a shot, and there are a variety of other, complex reasons why people aren't rolling up their sleeves right now. And so, basically that allows the virus to keep spreading. It increases the risk of more problematic variants emerging. And, that's not to mention the vast numbers of people across the world in lower and middle income nations in particular that have only received tiny amounts of vaccines. So that is what is sparking worries among, some scientists and researchers and companies that, we're not out of the woods yet, right? We could be dealing with this for quite some time.
Should the focus, therefore, be on cases, or should the focus be on hospitalizations? I come back to the Israeli data, which showed quite a marked drop in efficacy, but a significantly smaller drop in efficacy in terms of preventing hospitalizations. Should we be focusing on the latter number?
Yeah, and there should be a stress and emphasis on the hospitalizations and the deaths, no doubt, right? I mean, this data that we're seeing in Israel today is pretty consistent with the findings we've seen elsewhere. Here in England, health authorities a few weeks ago, I believe, released some results showing the vaccines from Pfizer and AstraZeneca were highly effective at preventing hospitalization against the Delta variant. And these numbers that from Israel that we're seeing today, show the vaccine is, I think, 93% effective in preventing hospitalization, and that's dropped only slightly from the 98% we've previously seen. So obviously those are very encouraging figures, and the companies and scientists will point to that and say, well, the vaccines are continuing to provide protection against these new mutations, though potentially slightly reduced effectiveness. So now there's, uncertainty, about the next variants that could emerge, but there are some positive signs there.
James, the debate that's certainly raging here in the UK is about kids and schools and bubbles and whether or not actually you need to send all the kids home once you get one case, and whether or not you need to vaccinate children. And at the moment, it does seem that UK scientists are taking a fairly cautious stance. In the US, the debate is further advanced. Can we get to the point where we can learn to live with the virus without vaccinating certainly secondary school children?
It's a really good question, and I think it remains to be seen. I mean, some people would say that the UK, is behind the US in this regard, and we'll need to kind of advance and do that at some point soon. I mean, we're still getting more and more data and learning more and more about this virus. So I think it remains to be seen, but and a lot of it will depend on on future variants and the extent to which the UK and other countries that are in this kind of more favorable spot right now can catch up with the virus. Right now it's a big race, and the variants are outpacing our efforts. So it certainly looks like things are heading in that direction, but we'll just have to wait and see.
Useful update, James. Really interesting. Thank you very much indeed. Bloomberg's James Patton on what is happening with the virus. US stocks, bond markets closed, of course, today for Independence Day. 4th of July yesterday, 5th of July today. But as we go to break and look at some of our coverage of the July 4th celebrations at the Boston Pops.
Romaine, welcome to the party.
Alex, I'm so thrilled to be here to finally celebrate our nation's birthday and to celebrate the return of live performances.
Yeah.
Country road, take me home. For heroes we lose in the fight. Come on and go with me. Well, no hatred. Come go with me.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Let's check in on the Bloomberg First Word News. I'm Laura Wright. China's President Xi Jinping held a video summit today with the leaders of Germany and France. The three were said to have discussed trade, climate and biodiversity. Beijing and Europe are trying to keep human rights disputes from scuttling efforts at cooperating in other areas. The global economy is now left to guess at how much oil it will get next month. That's because the OPEC standoff between Saudi Arabia and the United Arab Emirates hasn't been resolved yet. The Saudis want OPEC and its allies to increase production over the next few months and also extend a broader agreement to the end of next year. The UAE wants better terms for itself and argues that the proposed agreement to extend quota limits to the end of 2022 is unfair. The Vatican says Pope Francis is in a good condition a day after he underwent surgery to remove half of his colon. A spokesman said the Pope was alert and breathing on his own. He's expected to be hospitalized in Rome for about 7 days. And in Turkey, inflation accelerated faster than all estimates last month. That's a blow to President Erdogan's hopes of an interest rate cut this summer. Consumer prices rose an annual 17.5% through June. That's up from 16.6% the previous month. Global news 24 hours a day on air and in Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Guy.
Laura, thank you very much indeed. Laura mentioning a number of things that I want to focus on as well. Let's start off and take a look at what's been going on with the Stock 600 today. Superlight volumes, the US is out the 5th of July today. 4th of July yesterday, holiday today, as a result of which all markets closed over there. So over here, we've got very light volumes. Equity markets generally down by around 40% in terms of volume, a little higher, ticking a little higher for the stock 600 right now. I wouldn't take too much away in terms of the price action that we're getting. We've been kind of mid 450s for really quite some time, pushing up a little bit over the last couple of sessions. The pound gaining a little bit of traction against the US dollar. We're going to be hearing from Boris Johnson at 5 p.m. London time today, noon in the United States. He is expected to confirm the final reopening here in the United Kingdom, an end to mask wearing, etc. We'll see exactly what the details look like, maybe a little bit more nuanced than that, but nevertheless, maybe another boost for the UK economy. We've got data out Friday, GDP numbers. We'll look forward to seeing exactly what is happening there. The big story in some ways today is what is happening in the oil market, and the big story actually is that nothing is happening in the oil market. We're waiting the start of another critical meeting at the OPEC Plus gathering. We still don't know whether there's going to be some sort of resolution between the UAE, Abu Dhabi, and Saudi Riyadh. We have a disagreement at the moment that could potentially really have major implications for the oil price. Either way, you could see a breakup of the agreement. You could see a breakup of discipline within OPEC. That could produce an awful lot of oil coming onto the market. And the other option is actually we get a deal, and that reduces effectively the amount of oil coming on, or it kind of manages the amount that we're going to get. So potentially on one side, you could see prices dropping sharply. On the other, you could see a complete lack of oil coming on, and as a result of which, you could see prices moving sharply to the upside. The oil market doesn't know what to do right now, as a result of which it is doing nothing. So that's how it breaks down from a sector point of view here in Europe. Stock 600 up 0.3%, but as you can see, the banks really catching a bid. The miners up quite sharply, led by Glencore, and then you've got the travel and leisure sector, which is being boosted by the potential UK reopening. We're going to talk about all of that next. We've got a great guest coming up that's going to give us a take, certainly on what is happening with the commodity stocks. Alan Custis, Lazard's head of UK equities. He's up next. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Monday, the 5th of July, 30 minutes to the European close. Live from London, I'm Guy Johnson. We're counting you down to the close. We've got a lot to talk about over the next 30 minutes, over the next hour. Alex Steele has a well-deserved day off today after the 4th of July yesterday, the Boston Pops celebration. Let's talk about where we are with the markets right now. The FTSE, the DAX, and the CAC, the SMI, not going anywhere in a hurry today. Certainly a little bit of outperformance coming through from the London market. Barclays is doing relatively well. Some of the mining stocks are on the front foot. Glencore, certainly a name to talk about. The DAX fairly flat. The CAC up by around 0.3%. The SMI over in Zurich going nowhere in a hurry. But volumes are sharply to the downside. For instance, the DAX down around 45% in terms of the regular 100-day average volume. So as you can guess, we are getting an effect from the closure that we're seeing over in the United States as a result of the 4th of July, 5th of July holiday. But there is plenty to talk about. As I say, OPEC Plus, we still don't have a resumption of talks. We were expecting a meeting. It feels we're about 2 hours now behind schedule. No sign of a healing of this group. We still have not resolved the increasingly bitter and public split between Saudi Arabia and the United Arab Emirates that's blocking an output deal. We heard from both of their energy ministers over the weekend.
We sacrificed a lot. We will continue to sacrifice until the end of this agreement. That's our commitment. But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
The agreement requires that we bring more production, yes. But to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend.
The energy minister is talking to Bloomberg's Amory Horden over the weekend. Let's talk now to Bloomberg's Will Kennedy to get his take on this situation. Will, we're waiting for a meeting. Are we going to get one?
Not clear at the moment, Guy. I mean, as we understand it, they're not ready to start yet. We understand there's some bilateral conversations going between different sets of ministers. They probably won't want to start the meeting until there's some sort of compromise on the table. It appears everyone's still dug into their position, and we haven't had a big breakthrough, so it looks like that stalemate persists.
The oil market doesn't know what to do with this, does it? Sitting on its hands, oil prices going nowhere. I guess that's because, on the one hand, we could get a significant move to the upside. There is the possibility we get the exact opposite.
I think that's right. It's a very hard situation to trade, because if they stand pat and don't do anything at meeting, under the rules of the current deal, they just wouldn't raise production and meet again in a month's time. Now, that would clearly be bullish, because the market had been expecting a rise of 400,000 barrels a day under the terms of the agreement negotiated last week, and it's not going to get that. But there are clear risks to the downside. There's the risk, which is probably still a remote risk, that this all falls apart and you get a return to some kind of pump at will or even a price war like we saw last year. But probably the greater downside risk for traders is that, you know, the UAE is going to find a way, one way or the other, to put more oil in the market. It appears especially determined to do that. And even if it does it through OPEC, you know, OPEC will need to find a way to accommodate that oil if it's going to keep the deal together. The Saudis don't like it. So one way or another, the oil's coming. And so that's the bearish risk for traders, I think.
Well, the sense seems to be, though, and it's been gradually happening, that OPEC is finding it more and more difficult to manage its internal politics. And it's not just about oil. The relationship between Saudi Arabia, Abu Dhabi, and Riyadh becoming more difficult on a number of different fronts. What does this mean in terms of not where oil is now, but where oil is in a year's time, 2 years' time? How easy is it going to be to continue to manage this situation, this oil price, as a homogeneous group?
There are two things there. I think you're right to point out that the relationship between Abu Dhabi and Riyadh isn't what it was. Traditionally, they were seen as by far the closest allies within OPEC, and what Saudi did, the UAE would follow. And clearly that's broken down both in terms of oil, where the UAE is very keen to pursue a path of growth and investment. And it also, the wider relationship, particularly between the two princes, Mohammed bin Salman and Mohammed bin Zayed in the UAE, isn't what it once was, and there's been tensions about the war in Yemen, among other things. But I think there's another aspect. It's much easier to forge unity when oil is $20 a barrel than it is at 75. And the oil market is vastly repaired. We should look at the turnaround, and, that's going to make some countries chafe. So I think it is getting harder to hold the deal together. And I think that, it's very much Prince Abdulaziz's deal. He's fronted it and argued for it and tried to keep it on track. I think these are tough times for him.
Well, we'll leave it there. We'll continue to monitor what is happening, and we'll watch for news on Bloomberg News. Bloomberg's Will Kennedy. Joining us now, Alan Custis, Lazard Asset Management, Head of UK Equities. Alan, we don't know which way the oil price is going to go. We've got a 76 on Brent right now. What does it mean for the big energy majors?
Yeah, good afternoon, Guy. It's a very good question, and as Will was saying, it's not clear how this is going to play out. But a couple of things, I think, from an investment standpoint. First and foremost, UAE have been a very responsible part of OPEC, and we're not envisaging sort of a breakdown in OPEC as a result of this. Is more about allowing them the capacity and not necessarily allowing someone like Iran to take extra barrels. As you were saying, Guy, the backdrop actually is incredibly positive. We are drawing 2 million barrels a day at the moment. So the excess inventories that we built up during the pandemic, when nobody was flying and people were working from home and transport wasn't being utilized in the way it now is, we are drawing down on those reserves very, very quickly. And at the same time, before we would say the release valve of US shale would probably keep a lid on the oil price. But what we're seeing at the moment, if you look at the latest data on the rig counts, is before the pandemic, we were around about 700 rigs being utilized in the States. The current number as of the 2nd of July was just over 370. So there's been no response from the States in terms of trying to take advantage of this higher oil price.
Yep.
So my standpoint, we will underpin between now and the year end. I mean, turning to the companies, obviously we've got the big major oil companies here in the UK reporting in the next 4 weeks, I think being led by Shell on the 29th of July. The key will be really what they're going to talk about in terms of, monies back to investors. I think that the oil companies here in Europe, and particularly the UK, badly served investors when they cut the dividends back in the first quarter of 2020. And frankly, their shares have not recovered at all. They're still down some 20% from pre-pandemic levels, whereas Exxon and Chevron, who didn't cut the dividend, are back to pre-pandemic levels. So I think the market will be very keenly focusing on, what is the dividend, what is the buyback going to be, and at the same time, how much they're going to be investing in renewables.
Alan, miners are trading quite strongly today. Miners, oil companies, where do you think the balance should be in favour of?
I think it's mine. Oil companies, sorry, Guy. Oil companies definitely, to my mind, are more attractive. We're starting to see some soft Chinese data coming out. We're also seeing from an iron ore market, Vale starting to flex their muscles in terms of the supply coming into the seaboard market. We've also got, obviously, in the backdrop, Simandou in Africa as a sort of a backstop, very substantial iron ore resource. So I always say, you should be selling the miners on Ps of 5 and buying them on Ps of 50 as deep cyclicals, and we're kind of there now. Whereas the oil companies, I do think, as the world reopens post the pandemic.
Okay, guys, position closed on Euro, as you can see. We closed position just right here. We sold short at 3 o'clock. We closed at 10 to 4. We made £200 in profit. Well done, guys. Let's move on. All of you guys who copy our trades, you already got confirmation. For new guys, you need to get a strategy if you want to trade some other pairs of stocks, indices. You can get strategy from companyeye.co.uk. Let's move on. Let's move and see to what other pairs, what other opportunity will bring us to trade pairs, trade Forex or Bitcoin. I'll speak to you later, guys.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Let's check in on the Bloomberg First Word News. I'm Laura Wright. In South Florida, demolition crews used explosives to bring down the remaining portion of that partially collapsed condo building. Hours later, they reported they found 3 more victims in the rubble. That brings the death toll to 27, with almost 120 still missing. President Biden has all but announced an end to the pandemic in the US. He celebrated what he called a heroic vaccination campaign on the country's Independence Day holiday. The president missed his goal of having at least 70% of adults in the US getting at least 1 dose of a vaccine. The total is now 67%. The Vatican says Pope Francis is in a good condition a day after he underwent surgery to remove half of his colon. A spokesman said the Pope was alert and breathing on his own. He's expected to be hospitalized in Rome for about 7 days. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Guy.
Laura, thank you very much indeed. The takeover battle for Morrison the grocer certainly heating up. Apollo now said to be considering a £6.3 billion offer for the company. We've obviously got the offer on the table from Fortress Group. We've had CD&R in the mix as well. Rumours are Amazon could be out there as well. Joining us now, Bloomberg senior UK correspondent Ruth David. Ruth, the first question is a fairly obvious one. Why are UK grocers suddenly hot property?
Hi, Guy. All UK companies actually, their value has been lagging in terms of trading basis relative to their global market peers. So that's one. Secondly, UK grocers have had a pretty good pandemic, right? There's been an increase in grocery spending. And thirdly, Morrison's itself, the real estate piece is very interesting. It owns about 85% of its almost 500 stores as well as manufacturing sites. And that real estate alone was valued at about £6 billion, which if you remove the takeover premium that the company is trading in right now, the real estate value was higher than the company's market capitalization. So you have a situation where private equity and investment firms are looking at these companies and saying, well, investors are not valuing them at a premium. Why don't we see what we can do?
Ruth, that is apparently becoming clear now to the market. Obviously, we're seeing share prices going higher. Private equity, though, has a lot of money to deploy. Do you think we're done with this story yet? Or do you think actually we could see others stepping in? Apollo is the latest story. There was some talk over the weekend about Amazon being interested as well. Obviously, not a private equity business. But how much further do you think we've got to go here?
I think any private equity, and you have to remember that private equity is sitting on record levels of cash right now. Now that they know Morrison is out there in the open, you know, it's in play, they're going to look at it and think about whether they can make the numbers work. Amazon is the one strategic buyer people have been talking about. We have no indication yet that they will make an offer. I think if you're an investor in Morrison, you just hold on to the share right now, or you sell because it's trading above the firm offer price.
Yep.
But there is talk about the CDNR come back with a higher offer. Does Apollo make an offer that has to be higher than the one on the table right now? So it's a good time to be a Morrison investor, clearly.
Yeah. Ruth, we've just seen a comment coming through from Boris Johnson's spokesman saying this is a commercial matter. Now, that's interesting. It sounds like a kind of throwaway line, but I don't think it is, because there's a lot of concern, and certainly reading the weekend papers, last weekend's papers as well, that private equity is basically stepping into the UK and buying UK assets on the cheap. And actually, this should be something that government is concerned about. Do you think we're going to get any kind of pushback from regulators or from government in terms of some of the offers that are being made?
And we heard that Fortress was reaching out to key people in the government to lay out its case. The UK has traditionally not intervened in deals the way that, say, France has. We saw that happen with Carrefour and Couche-Tard earlier in the year, where it was a retailer and they said national security, this doesn't make sense for us. I think the government will have to take a close look at it, given that Morrison is a retailer that is so entrenched in the food security of Britain. To what extent they do something remains to be seen.
Ruth, we'll leave it there. Thank you very much indeed, as ever. Look for some more great reporting out of the Bloomberg team. I just want to break a bit of news for you. We were focusing just a moment ago on what is happening with this OPEC Plus meeting or not meeting. They are not meeting, apparently. Looks like the meeting has now been called off, the Monday meeting. This, according to a delegate. We'll wait for a sort of more formal confirmation of that, but it was already well overdue. So maybe we should have expected this. We'll see exactly what happens with this narrative tomorrow. We'll certainly come back to it. But let's come back to what is happening with Morrison's and actually the wider story about what is happening here in the UK. Certainly there is mounting frustration that maybe UK assets are being undervalued, and as a result of which private equity with a lot of money sitting on the sidelines is coming in. Let's get Alan Custis' take on this, joining us from Lazard again. Alan, what are your thoughts? The FT this morning talking about Cobham. We've got this story unfolding with Morrison. There are plenty of other examples out there at the moment. As a fund manager that holds many of these stocks, what is your position?
I'm sympathetic towards private equity. I mean, you know, you've been able to buy these stocks at these valuations for years. I mean, just before I came in to talk to you, I was looking at the Morrison's average price target, which is an average price target of all the analysts. And over the last 2 years, it has been falling and falling and falling. So I'm not surprised that private equity is taking, you know, a much greater degree of interest in UK stocks. And, you know, we've talked about why the UK has been out of favour. And frankly, I think even with the volume and levels of bids that we've seen so far this year, the UK still remains a very, very cheap market. And so when I'm talking to my clients, I'm saying, you know, you can expect bids to continue. And I don't think, frankly, the government's going to be able to do anything to block these volume of bids as I see it at the moment.
Do you think it will take more strategic looks at certain examples? Like Cobham was one example that was cited, but do you think it could become more selective in terms of the way it approaches it? Or do you think it is just going to be a free-for-all? You think there are plenty of undervalued assets out there?
I think one of the things that we've missed, and I've been thinking about this recently, is they tend to be quite asset-backed, the deals that private equity go for. If you think about it, Guy, the cost of launching a bid is tens of millions of dollars, or pounds even. And I think they're easier to bank if there's asset backing. And so I think that we, as fund managers and indeed analysts on the sell side, have underappreciated the value of some of these assets. And then bringing it back to, obviously, Morrison's 87% of their assets are freeholds. Even something like Tesco, you're talking about 57, 58% of their assets are freehold. And I think from private equity standpoint, the banks are probably more receptive to going down that type of company than perhaps one which has substantially less asset backing in its balance sheet. So I think we might sort of rethink how we're looking at the balance sheet, whereas, you know, as an industry, we focus on earnings. We don't focus so much on the balance sheet. And I think that's the thing which private equity is clearly doing and really focusing on at the moment.
Well, how should we look at the UK fund management industry? How should we look at the analyst community that they have mispriced these assets for so long? If you are looking to invest in the UK, how should you be thinking about the kind of advice you're getting? What are these assets actually worth? What potentially should you be looking at? Where should you be looking? There's a lot of criticism about the city at the moment being kind of 19th century, at best 20th century, certainly not 21st century. Is this just another example of that?
I think it's a very complex point, Guy, in that, you know, investors have not been positively disposed to the UK market for some time. Retail clients have been sellers of UK securities for global securities for many years. Institutional clients have been sellers of UK equities for global equities for many years. So UK investors like myself have had monies taken away from them to be allocated to other asset classes. It means your ability to access some of these, you know, very good value stocks just becomes a lot harder. And so I think, you know, there is a question mark, I think, also at the moment with the volume of IPOs, that I think a lot of the sell side and indeed ourselves, we are, you know, getting quite wrapped up in the volume of IPOs. And I think there is a risk that we are, you know, letting private equity in through the back door, so to speak. And so I think that's, again, something which, you know, is Morrison's the wake-up call we've all needed? Yeah, possibly is. We've now got 5 private equity firms interested in it. Obviously, Asda was bought. There's a significant stakeholder in Sainsbury's, and then you've got Tesco's.
Alan, just before I let you go, it looks like we're getting news coming through from OPEC. Doesn't have a date for the next meeting to continue with quotas at current levels. I'm just going to see if there's a reaction in the oil price to this, but it looks as if we are going to stick with what we've got. We're starting to see oil ticking a little bit higher, Brent trading at 76.80. But I'm assuming this is confirmation of kind of your case surrounding the oils, that we are going to see higher oil prices. We're starting to get a spike coming through now, and this is kind of reinforcing your view of what these oil majors potentially could be worth.
The risk is that oil goes absolutely crazy, and that's not something that OPEC clearly wants. So they are walking, I think, as Will said, a bit of a tightrope at the moment. But definitely, you know, demand is on their side, and supply is definitely not on their side. So in terms of supply outside OPEC, so they've got all the cards, and they just need to navigate the kind of quotas amongst themselves. And I think that there is a very good possibility that's going to happen, and therefore we should be expecting oil prices to be higher between now and the year end.
On that note, we'll leave it. Brent beginning to look at kind of $77 a barrel, just shy of it. Alan, always appreciate your time, really appreciate your time. Alan Custis, Lazard Asset Management Head of UK Equities, greatly appreciated. This is Bloomberg.
the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Oil prices rallying on the headlines we've just had from OPEC. A delegate reporting that the meeting we were expecting today not going to happen. No scheduled date for the next meeting, and significantly, and this is the real takeaway, crude. We're going to see basically OPEC falling back on the previous agreement, and as a result of which the oil market is going to get less crude than it thought it was going to get. That's the reaction in Brent. We're starting to see the market now getting a direction. As you can see, 76.80 is where we're now trading. This as we head into the European close. European equity markets largely becomes low volume. Certainly a theme of the day. The close is next.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
So we're wrapping up the Monday session here in Europe. We're coming through into the final close. Let's take a look at where we are with the numbers. Remember, the US is out, 5th of July, holiday after the 4th of July, volume super light. Not much signal, I would therefore argue, in some of the noise we're getting out of the markets today. We're up by around 0.3%. Again, we've been in the kind of mid 450s. We're actually starting to climb to the upper end of that now. We've been locked in an incredibly tight range for European equities for really quite some time. Maybe a little bit more traction today. We'll see what happens when the States comes back yesterday and what kind of direction we can get there. Obviously, a fairly big week. The data started to pick up. Fed meeting, the minutes from, ECB meeting, accounts from. We'll get those later on as we work our way through the week. Still digesting the payrolls, obviously, from Friday. A nice number, but not nice enough, really, to tip the balance when it comes to the Fed. So that's where we are, 458. I want to talk a little bit about something that may move markets, though, and that is worth watching out for, and that is what's happening with the crude price. We have, over the last few minutes, had these headlines coming through from OPEC, the delegates indicating maybe that the meeting is not going to take place. We don't have a meeting date now, so they're not going to be meeting for potentially a while. It looks like we're going to fall back on the pre-meeting agreement, i.e., the oil market's going to get less oil from OPEC than it originally anticipated. This because Saudi and the UAE are clashing. That's positive for oil. As you can see, we're getting a spike in prices. Not that big a spike, actually. We're certainly not taking ourselves significantly higher. But basically, you think about it, we're kind of where we were, as you were. So basically, a little bit of a spike higher. Maybe we weren't, and we're not going to get quite as much oil. But this is not the worst-case scenario on either end. So this is not the tail risks. So the market's kind of sitting in the middle of that, kind of mid-70s. Maybe we push up to 80. Certainly some analysts are talking about that. But 76 right now. That's going to have an impact on the oil majors. We are obviously seeing the commodity-focused markets like the FTSE 100 outperforming. Today, it's about the oils. It's also about what's happening with some of the mining stocks as well. I'll talk about Glencore in just a moment. On the continent, again, super light volume. The DAX absolutely flat. The CAC Caron's up by around 0.2%. Quick look at the kind of the sector narrative here, because this is where the interesting stuff actually is happening. We're seeing what is quite an interesting little rotation. Banks bid today. Basic resources, the miners trading higher. Travel and leisure doing relatively well. At the top of the hour, we're going to get an announcement from Boris Johnson. That may be that if you've had both vaccinations, you can travel out of the UK to what the UK designates as amber list countries and then come back without quarantine. That's quite a big deal and quite a big step forward for the travel sector. We're also starting to get, for instance, Virgin, Atlantic, and some of the other airlines being able to restart operations at Terminal 3 at Heathrow. Bottom end of the market, healthcare down by around 0.4%. Tech's catching a little bit of an offer as well. Media down by 0.2%. In terms of the individual names, let's focus on what we're watching out for here. We've already talked a little bit about Morrison. Morrison, the supermarket, up by 11.38. Potential Apollo offer coming in. Potential, like some people are saying, Amazon offer coming in. We'll wait and see. But certainly UK supermarket's pretty hot right now. As I mentioned, the travel stock's doing really well. IAG, owner of British Airways, owner of Iberia, up by nearly 5% today. And then there's Glencore. I was talking about the miners, up by 1.5% today, kind of completing the lineup with the addition of a new chairman. This, as we see Ivan Glasenberg and the management team sort of stepping back. So we're seeing a kind of new generation coming through, the market liking that, plus also the more positive data coming out of China, certainly helping out the mining sector today. So the broad sector, as we've already indicated, trading sharply to the upside. Sharply, maybe I'm overestimating. Trading to the upside today. Let's talk about what else is happening. Really interesting weekend down in France. An event some people call the French Davos. Certainly got better weather. Aix-en-Provence, the economic conference taking place over the weekend in the Luberon, southeast of France, south of France. For the first time in 2 years, French and European business leaders able to gather in person to discuss the recovery and the political impact, of course, of what is happening with the pandemic. Bloomberg's Caroline Conan speaking exclusively with the French industry minister, the German economy minister, as well as the CEOs from Michelin and Euronext about the risks that are still out there.
We need to be cautious about the Delta variant. We are still in crisis. We have India is still in massive problems. The entire South America is in big turmoil. The Southeast Asia, excluding China, has not vaccinated, and they have started only a few days ago. The crisis is not behind us. It's just that the fundamental drivers of recovery are there. The unprecedented amount of fiscal stimulus, the unprecedented amount
of monetary stimulus, the very strong good surprises about how the productive machinery of developed economies have been preserved during that crisis.
The point is now to have the most people being vaccinated in the less time possible and to ensure that we have a close monitoring of the circulation of the variant.
I'm extremely optimistic. I mean, the combination again of growth, fundamental growth, vaccinations are very positive trends that should encourage us to see in a very positive way the months ahead of us.
In terms of economic recovery, I'm not anticipating anything happening before second semester 2022.
Esti Dweck, the Natixis head of global market strategy, joining us now off the back of that. Esti, let's talk about the financial markets, your perspective on where we are with the virus. There seems to be this sense within financial markets that it's in the rearview mirror, that we can focus on the reopening, that it can be managed, that while cases rise, hospitalizations aren't. Is that the correct way of looking at things?
For now, it does seem to be. When you look at the UK as an example, you see that the link between, as you said, cases and hospitalization has been broken by vaccination. And very little willingness from policymakers to have renewed lockdowns. So at the moment, it does look like it's the right way of looking at things. We have vaccination, which is the best tool to fight this pandemic. Treatment is also getting a lot better. So even in hospital, we're getting better at protecting people. We know, I'd say with almost certainty that the US is not going to go into renewed lockdown. It'd be very difficult to impose on the population. In Europe, we know some of the governments are planning for a fourth wave or how to manage that in the fall. But really, so far, unless hospitalizations really start to pick up significantly, we can continue to think about reopening. Still, the last thing I'll say is we really need to vaccinate as fast as possible to make sure we don't get other variants that could prove resistant to the vaccine. So it's a bit of a race against time.
So as we think about the second half, is this about as good as it gets? Growth is good, picking up. Virus seems to be under control. We've got central banks that are still super accommodative, and there's loads of liquidity out there. Is this as good as it gets? Markets, equity markets are meant to be discounting mechanism. They're meant to be looking kind of 6 months, a year down the road. What does the world look like 6 months, a year down the road? We've priced in a great recovery. The debate now is, does it continue in the second half, or do we see equity markets starting to fade? What's your take?
So 6 months out, I think we have less visibility than we did in the first 6 months of the year. But as you said, all of these tailwinds are still there. They are receding gradually. They're not as strong as they were. There is going to be debate about tapering, and eventually they're not yet rate hikes. That's for the Fed and even the ECB, and what is going to happen with the PEPP program in March next year. Fiscal stimulus is, again, continuing, but for sure past the peak. So you still have these fundamental supports. You still have reopening. You still have strong growth expectations. When you look at the 2.5–3 trillion of excess savings in the U.S., the U.S. consumer isn't going anywhere. The U.S. economy should remain strong, maybe not at Q2 levels, but will remain strong. So it's difficult to imagine a very negative scenario for equities in this context, but it's probably going to be a little bumpier going forward.
How much juice left is there in the cyclical trade?
For me, it's more of a question of how long than how much. I don't think we're done with the cyclical trade. I think there's more room to go. We're still reopening. Not all the travel is done. Not all the vaccination is done. We've seen a long pause, but I think it can continue. I'm not sure if it lasts much more than a few months from here. And as we were saying, if growth starts to peak and a lot of these tailwinds start to fade a little bit, we might see investors come back to more defensive growth type stocks.
So you think you got a couple more months left, but just in terms of risk reward, I appreciate what you say about kind of the timing issue, but if it's only another 2, 3, maybe 5% left on the table, I'm trying to balance when I make that move. So the amount is relevant here as well. I appreciate what you're saying about the timing, but if there's only a couple of percent left on the table, don't I make that move a little earlier?
So the reality is, especially if you're thinking U.S. market, the tech sector is so big that that view is almost more important than your sector or your cyclical view. So yes, if you are in the camp of only a few more months, you can start to reallocate. We've said from the beginning that you shouldn't dismiss tech, even if there was some short-term underperformance. So that remains the case. For Europe, it's a little bit more balanced, and we do have an ECB that is really actively protecting banks' margins. So financials should continue to do well. So if you're in it, I think I would hold on a little bit longer. If you're debating, then again, if you're in the US, maybe shifting back a bit more into tech makes sense.
We've got a G20 meeting coming up later on this week. Tax certainly front and center, a global tax deal. Plus, we've obviously got what is happening stateside. You've got to get into the weeds on it, but there potentially could be some quite significant changes in terms of the way taxes are going to work, particularly for the wealthy in the United States. Is the market underpricing this as a risk?
Absolutely. I think the market today thinks Biden will manage something on infrastructure, but he won't get the tax hikes through. And I do believe that it's a bigger risk than what the market is pricing in. Now, when you do the math, and we spent a lot of time on that earlier in the year when we were talking about the potential tax hikes, the reality is from an EPS for 2022, the impact is maybe 5 to 7%, depending on how much Biden manages in terms of the corporate tax rate and then other potential taxes he wants to add to that. So it's perfectly manageable for the market. But the headline risk and the sentiment risk, I think at the moment are still underappreciated.
Esty, let's leave it there. Thank you very much indeed for your time today. Esty Dweck of Natixis. Thank you very much indeed. Really interesting. Okay, let's get a take on where European stocks have settled. The auction probably a little lighter today in terms of the volume. Certainly volume has been light throughout the day, but these are your final numbers. FTSE outperforming. You've seen IAG doing well today. You've seen Glencore, the miners, doing well today. The oil price, Philip, is also helping out some of the miners there as well. So that trade certainly on. But for the rest of Europe, a quiet session. Waiting for guidance, I think. The return of Wall Street tomorrow. But those are your final numbers. This is Bloomberg.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Let's check in on the Bloomberg First Word News. I'm Laura Wright. The global economy is now left to guess at how much oil it will get next month. Delegates say the OPEC Plus coalition has called off today's meeting in the midst of a standoff between Saudi Arabia and the United Arab Emirates. The Saudis want OPEC and its allies to increase production over the next few months and also extend a broader agreement to the end of next year. The UAE wants better terms for itself and argues that the proposed agreement to extend quota limits to the end of 2022 is unfair. China's President Xi Jinping held a video summit today with the leaders of Germany and France. The three were said to have discussed trade, climate, and biodiversity. Beijing and Europe are trying to keep human rights disputes from scuttling efforts at cooperating in other areas. In Turkey, inflation accelerated faster than all estimates last month. That's a blow to President Erdogan's hopes of an interest rate cut this summer. Consumer prices rose an annual 17.5% through June. That's up from 16.6% the previous month. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Guy.
Laura, thank you very much. So, as raw material prices surge in the wake of the pandemic and disrupt the global supply chain, European companies are starting to push up prices. That's what industry bosses told Bloomberg's Caroline Conan at the Aix-en-Provence Economic Conference over the weekend. The CEO of the French tire maker Michelin also talking about the impact that this is all having on his business.
We see some shortages when the economy is catching up, exiting from the crisis on a worldwide basis, and we have shortages of boats, containers, some raw materials, and the entire upstream supply chain has been disturbed. The impact for us is we see our input costs rising, but fortunately the Michelin brand is very strong and we are able to pass it to our customers.
So the consumers, the customers will end up paying the price?
Yes. At the end, it's always the customer that pays the price.
So how much does that represent in terms of increase of price for the customers?
It's we have risen our prices twice already, once early March and the second time in early July. It's around 6 to 8% cumulative.
More generally, what's the impact of inflation on the transport sector?
Let me give you an example. The price of a container shipped from Singapore to US was pre-COVID in 2019, end of 2019, at $2,400. Now it's at $9,800.
So you're expecting a 2023 recovery. Do you think the Delta variant could derail this forecast?
Of course, but the world is, everybody is anticipating that we are already on the exit, and I'm still saying we are still in crisis. We have India is still in massive problems. The entire South America is in big turmoil. The Southeast Asia, excluding China, has not vaccinated, and they have started only a few days ago, and therefore the economy is not yet back to its normal level. So the Delta may have an impact, may slow down the recovery in Europe and in the US, but I trust that we will be able to vaccinate more people, and therefore we should exit this. But in terms of economic recovery, I'm not anticipating anything happening before second semester 2022.
Michelin CEO speaking exclusively to Bloomberg's Caroline Conan at the Aix-en-Provence event. What do we got for the rest of the week? We're done with Monday, almost. Tuesday, Australian rate decision. You want to watch out for that one. That could actually be really interesting. PMI's data as well out of the States. Wednesday, we get FOMC minutes. Keep an eye on the JOLTS report as well. Always a useful indicator as to kind of what is happening in terms of the supply of jobs, job openings. Thursday, claims, EIA oil report. Friday, we get the G20 finance ministers meeting. We get US wholesale inventories as well. Keep an eye on, obviously, the ECB accounts. That is certainly something you want to watch out for. I think the Fed meeting, the Fed minutes, probably more interesting. But nevertheless, keep an eye certainly on both. We'll have some great coverage here on Bloomberg. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Laura Wright. Credit Suisse plans to give its Swiss employees what it calls maximum flexibility when it comes to working remotely or in the office. They'll be able to decide with their teams and managers how much time they want to spend outside the office and which days to be in. Credit Suisse is joining rivals such as UBS, Deutsche Bank and Citigroup that will allow employees to work remotely at least part of the week. The biggest brokerage in Japan, Nomura Holdings, has suspended coverage of more than 24 companies. That's because of the departure of two of the firm's highly rated stock analysts in Tokyo. This comes at a time when Nomura is trying to reinforce research as part of its broader growth plans. Among the 29 companies that are not being covered for now, Nintendo and Rakuten. And that's the latest Business Flash. Guy.
Laura, thank you very much indeed. We're just getting some news out of the UK. 2 doses of the Pfizer shot, highly effective against the Delta variant. This according to the UK government, which is now preparing to position the UK to learn to live with COVID-19. You're looking at a live shot coming from 10 Downing Street. Prime Minister Boris Johnson will, at the top of the hour, address the nation, talking about the final stage of lifting restrictions in the UK. What should we expect? What is this going to look like? Emma Chandra joins us now with what we should look forward to. Emma.
Guy, as you said, that press conference from the Prime Minister due to start in just a few minutes' time, and we're expecting to hear from him that he will go ahead with the final lifting of restrictions and the reopening or full reopening of the UK economy on July the 19th. But what will also be significant about what he says, we understand, is that there is going to be a shift in tone and a shift in responsibility for dealing with COVID, away from government and on to the individual. He's going to say that we have to learn to live with COVID in a way that perhaps we live with the annual flu season, and that is a very significant change. There will also be a number of specific things that will happen on July the 29th, which should make things very different here in the UK. We expect the Prime Minister to go ahead with removing the mask requirement in some public spaces, in shops, on public transport, etc. Also, all social distancing rules will be removed. We also know that nightclubs are able to reopen for the first time since March 2020. I'm sure you're looking forward to that, Guy. And also all restrictions on theatre, concert and sporting events as well. They are due to be lifted too if the Prime Minister goes ahead and says that we will go ahead with that July 19th lifting of restrictions, as we do expect him to do in just a few minutes' time.
Emma, I think the further away I am from a dance floor, probably better for everybody. But let's talk a little bit about whether or not this is a political decision rather than a scientific decision. Are the scientists behind this?
Well, that's a very interesting question, Guy. We know that some scientists have come out and said that they perhaps are not happy with the full lifting of all these restrictions. They're saying that perhaps you don't need to remove the mask requirement and social distancing at the same time. Of course, we are seeing big surge in the number of cases of coronavirus here in the UK, some 27,000 reported today. What the government is banking on is that the data so far suggests that high level of vaccination among UK adults, more than 80% with a first dose, more than 60% with a second dose, is going to prevent those turning into more deaths.
We'll leave it there. Thank you very much indeed. This is Bloomberg.
Freedom delayed. 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today I'm talking to Orlando Bravo, the Puerto Rican billionaire who's shaking up the pinstriped world of private equity. His firm, Thoma Bravo, has grown at a blistering pace, from $10 billion in assets to $80 billion in 5 years. Unlike his peers across the buyout landscape, Orlando does deals in only one industry, software. He calls it the best business in the world.
You have recurring revenues, you have high rates of growth, you have gross margins that are 90%, you have the potential for big cash flow margins, and software is becoming the business of everything.
The field is getting more crowded. Orlando and I discuss growing competition from hedge funds, why he'd never invest like ARK's Cathie Wood, how to do a SPAC the right way, cheering on the next short squeeze. Here's my conversation with Orlando Bravo. You buy software companies and only software companies. Why?
Well, that's easy, because software is the best business in the world. Think about it. You have recurring revenues, you have high rates of growth, you have gross margins that are 90%, you have the potential for big cash flow margins. It's a fragmented industry where you can consolidate markets, and software is becoming the business of everything.
Software was definitely hot before the pandemic, but now it's on fire, right? And money is pouring in. Tell me about the competitive landscape.
We have always had great competitors, and we continue to do so. Now, our competitive advantage in the market is that we've been doing this for 22 years, and in the process of buying 300 software companies, we have developed an operating know-how that really adds value to the businesses that we're partnering with. And most of the industry to this day, while you have seen great innovation and software is eating the world, most of the industry today is unprofitable. So to buy a whole company and do a private equity deal based on fundamental investing, which is what we do, you have to recreate that P&L. And you have to turn these great innovative companies into also cash-producing businesses. You have to combine the best of both. And if you've been doing it for a long time and have an operating model around it, you're able to achieve that. And that's what keeps many players really on the sidelines of this great software industry to this day.
It's true that many players are on the sidelines, but increasingly, there are firms that want to compete with you, right? Some of the largest private equity firms in the world are raising growth equity funds. They want to be the next Thoma Bravo, or maybe they want to be the next SoftBank. Hedge funds are becoming serious players in late-stage venture capital all of a sudden. Tiger Global, D1, others. Is that changing the competitive landscape? It has to be.
It's making it better. And this is why. Competition is a very good thing for us, and it's a very good thing for our peers. Because when there's competition, we alone don't have to create a market. When a company receives many different kinds of proposals, maybe a growth round proposal, an acquisition proposal, they feel a lot better about where they should be valued at and where they should trade.
So if software is as attractive as you say it is, and I believe you. And furthermore, you have a track record to back it up. Why hasn't everybody figured this out?
One is the lack of profitability in the industry overall keeps many players out. We started when we were very small, so you're doing small deals. So you can take the risk of learning operations and learning how to run these things in partnership with management when you're investing $50 million. Are you ready to take that risk when you're investing $7 billion and doing it for the first time, of turning a company from negative 10% to 40 while not hurting their growth rate and allowing that innovation curve to continue? That's a tall order. That's the number one reason. The second reason, which you astutely pointed out, is it's interesting how things work in our favor when it doesn't seem like they should, which is the high valuations of software. Those are a natural barrier to entry in the space. If software today traded for 12 times EBITDA and it was there, we would have 40 competitors. But that, in essence, keeps many players out of the business.
You describe your approach to buying and operating companies as not Silicon Valley. What do you mean by that?
Well, what I mean by that is, if you look at any conversation I've had with great venture capitalists in Silicon Valley, or any textbook about tech, the conversation is, in order to grow and innovate, you need to quote unquote invest. And of course you need to invest. But what Silicon Valley has termed that is, you can go ahead and lose money for a very long period of time in order to grow. And public investors almost believe that. If you show them a company growing at 50% revenue while being highly profitable, we get asked the question, are we not investing enough in the business? Should we be unprofitable? We come from the school where we've been mentored by these great operators that at a given stage of a company, the more profitable you are, the faster you can actually grow. Because you can take those excess margins and invest them in strategic growth, which is development, and in tactical growth, which is sales. And you create a bootstrap effect of that company where you don't need outside capital and many different shareholders with many agendas funding the company. Then you can also use your balance sheet to make accretive acquisitions without the dilutive effect of additional capital.
But that's not really how many of these companies are encouraged to operate. I'm thinking, for example, of many, if not most, of the companies in, say, the ARC Innovation ETF. These are companies that are just going for it, right? That's the thesis underpinning those investments. Spend whatever it takes to create a total addressable, even if you don't even know what the TAM is, spend whatever it takes to create a TAM, and somewhere down the road, everything's gonna be fine. Is that wrong?
We don't subscribe to that philosophy. We are perhaps too conservative. We could not invest other people's money on that hope, on a pipe dream. We just couldn't do it.
Why is it so fashionable then?
It could be. Look, in times when capital is very cheap, when there's a lot of it, when there's a great tolerance for risk. I'm not saying that that doesn't work, but on average and over time, it's all about fundamentals.
You still believe that?
100%. And
fundamentals are a dirty word in some tech circles.
And once again, that does not mean that you need to absorb things that are different. You can be a great fundamental investor, but notice what's going on in the gaming industry. Notice what's going on in blockchain. Notice how you can get disrupted in many different ways, and be open-minded enough to get into those areas, and don't be afraid to take risk, as long as that risk is consistent with the type of culture that you have and your ability to absorb it. And for us, a risk that is, let's invest for 10 years and see what's behind the door after those 10 years, it's too far out. It would not work.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What's the perfect example